Hey everyone, welcome back to the channel. Today, we're diving into crypto arbitrage, how it works, as well as some on eyes, why it's a solid way to make money in crypto, and how you can get started. Let's break it down. Crypto arbitrage is all about buying a cryptocurrency on one exchange where the price is low and selling it on another where the price is higher. The difference? That's your profit. Sounds simple, right? But let's walk through it. First, why do these price differences even exist? Crypto exchanges operate independently. So Bitcoin might be $60,000 on exchange A, but $6,200 on exchange B due to supply, demand, or trading volume. These gaps are your opportunity. There are a few types of arbitrage. The simplest is spatial arbitrage, buying on one exchange and selling on another. For example, you spot Ethereum at $2,500 on Binance, but $2,920 on Kraken. You buy on Binance, because transfer and make in there to for Kraken, sell, and pocket the $20 difference minus fees. Another type is triangular arbitrage, where you trade between three currencies on the same exchange to exploit price mismatches, like trading Bitcoin to USDT, USDT to Ethereum, then Ethereum back to Bitcoin for a profit. There's also statistical arbitrage, but that's more complex and uses algorithms, so we'll stick to the basics today. Now, how do you actually do this? Step 1. Research exchanges. You'll need accounts on multiple platforms like Binance, Kraken, Coinbase, or KuCoin. Compare their fees, trading fees, withdrawal fees, everything, because fees can eat into your profits. Step 2. Monitor prices. You can use tools like CoinMarketCap or CryptoWatch to spot price differences, or even arbitrage bots for automation. But be careful. Bots aren't foolproof. Step 3. Act fast. Crypto prices move quickly, so you need to transfer funds and trade before the gap closes. Pro tip. Keep funds on both exchanges to save time. Let's talk numbers. Say you buy one Bitcoin at $60,000 and sell at $6,200. After a 0.1% trading fee on both sides and a $5 withdrawal fee, you're looking at about $190 profit per trade. Small, but if you do this consistently, it adds up. The beauty? It's low risk compared to holding crypto long-term since you're not betting on price swings, just exploiting gaps. But it's not all smooth sailing. Fees are a big hurdle, so always calculate them first. Transfers between exchanges can take time, especially with blockchain congestion, so timing matters. Liquidity is another issue. If an exchange doesn't have enough buyers, you might get stuck. And watch out for taxes. Arbitrage profits are taxable in most countries, so keep records. Lastly, stick to reputable exchanges to avoid scams or hacks. So how do you start? Open accounts on at least 2 exchanges, deposit some funds, and start small, maybe $100 to test the waters. Practice spotting price gaps manually before diving into tools or bots. And always do your own research. That's crypto arbitrage in a nutshell. If you found this helpful, drop a like, hit that subscribe button, and let me know in the comments if you've tried arbitrage or have questions. See you in the next video.